Welcome, accounting boffins. You with Ashraf Patel and the crew. What's today's topic? Yes, fixed assets. Now, remember, you've dealt with fixed assets already. So what we're going to be doing is a bit of revision, and then we're going to go into a section that many of our learners feel I must stay away from. But after you're done with this lesson with Ashraf Patel, you're going to master the section on assets. Let's look at this. Have you ever thought about this? That what assets does a business need to operate? Depending on the type of business, they would need different assets. Okay? So if you're looking at assets, one of the most important assets any business would need obviously would be land and buildings. But depending on the specific need of that enterprise, they would need specific assets. More about that just now. So if we look at assets, and if we look at our mind map, or we look at an overview, what are we dealing with? Remember assets, you get non-current assets, right? And then in your different types of assets, you have a tangible asset, right? You have non-tangible assets, okay? Now, obviously, when it comes to an asset, the business acquires an asset in order to use it. So it's not, the asset is not bought with the intention of reselling it. However, it would become necessary for the business to sell the asset at some stage. And therefore, you now have to do what we call asset disposal, and yes, the famous depreciation. Now, all of these are terms that you are au fait with, but as we go along, you will see exactly how we're going to be using them and what we're going to be doing with all these terms. Okay, so now, if we look at the definition of an asset, what is an asset? An asset is something that the business owns and can sell for cash. So obviously it is a possession of the business, and it is something that has value, and therefore it can be sold, right? So by definition, an asset has value. What are the types of assets that you have? You have non-current assets. What are those? This is an asset whose value will not change in the next 12 months. In other words, the asset remains constant for a period of 12 months, and therefore it will fall within the category which we call non-current assets, right? Now, obviously, the terms are used interchangeably, so sometimes you'll hear me talking about fixed assets, sometimes you'll hear me talking about tangible assets. It's one and the same thing. Now, when we say tangible assets, what are we referring to? Assets that can be touched and physically seen. Obviously, when you're talking about a tangible asset or a fixed asset, you're talking about something that you can touch, something that you can feel, something that you can see, right? Examples of that would be land and buildings, obviously, equipment, furniture, and vehicles. However, you also get non-tangible assets, right? And here we're referring to assets that you can't touch. For example, patent rights, goodwill. You mentioned that this business has a goodwill attached to it. It's not something that you can see. It's not something that you can physically touch. But yes, it is an asset, but it's an intangible asset. All right, non-tangible asset. Examples of this would be trade names, for example, Nike, Coca-Cola, etc. Right, now, remember, all that we're saying is that think of your non-tangible assets as well. However, for the needs of our curriculum, you would not be expected to know how to deal with your non-tangible assets. A lifespan of an asset, if you take your personal assets, surely you can see that that asset has a lifespan. In other words, a computer has a physical life of 3 to 5 years. Did you know that? That it may last longer, yes, but generally it is expected to have a lifespan of between 3 and 5 years. Obviously, if you look at property, then definitely we're looking at an indefinite lifespan, because obviously you're upgrading property unless by some disaster or natural disaster the property gets destroyed. But generally the property is regarded as having an indefinite lifespan. The period of time that the business is expected to use a depreciable asset. Remember, we're talking about the useful life of the asset. So if we're looking at that laptop and we said, okay, we're going to use it for 3 years, that means that the useful life of that asset for your business would be 3 years. This means, therefore, that within a space of 3 years, you are expected to use that asset. So it has a lifespan of 3 years. Obviously, the asset after that period, it's no more usable. It now becomes redundant. Redundant means it is no longer, it may still be working, but in terms of the policy of the company, it is now regarded as a redundant asset, meaning it is no longer usable and it should be dispensed of, we should get rid of it. Okay, because obviously we're not going to use it anymore. What happens now? Now comes the next step where we have to replace that particular asset. The cost of replacing an asset to buy a new asset which obviously you're replacing one asset with another asset. If you're getting rid of one laptop, it's now time to replace it with another laptop. This may be used to value your tangible assets. In other words, what we're saying is your replacement cost will give you an idea now of what it would cost you to replace the existing asset that has reached the end of its useful life. Now we come to a very important term in accounting, and this is depreciation. Again, nothing new to you. We've dealt with it. We're just revising these terms. Assets decrease in value over time. We've discussed that. As you're using an asset, it is decreasing in value. The decline in the market value of the assets is generally from wear and tear, obsolescence, due to technological advancements. This decline in the value is called depreciation. Very simple. Take your personal asset, your laptop that you have at home. Initially when you bought it, you may have paid 20 or 25,000 rand for it. However, after 1 year, is it still valued at 25,000 rand? And the answer is an emphatic no. Why? Because you've used it for 1 year, it has depreciated in value, and that value that you've used is called the depreciation. Depreciation is what we refer to as an imputed expense, a very, very important word. What do we mean by an imputed expense? Allow me to explain. If you take a normal expense like salaries and wages, obviously you can see that when you pay your salaries and your wages, it has an impact on your bank account. Why? There's money, physical money coming out of your bank account into the hands of your employee. However, when you are depreciating your asset, the question that you need to ask yourself is that expense going to impact on my bank account? Definitely not. This means, therefore, that depreciation is what we refer to as an imputed expense, because we allocate the part of the cost to a specific accounting period. Clearly you can see the amount of depreciation that you've written off in this financial year is the expense allocated to that financial year. Obviously, there will be an expense to the next financial year until the asset reaches the end of its useful life. So once again, depreciation is an imputed expense. Now we look at accumulated depreciation. What do we mean by accumulated depreciation? A very simple example, let's take an asset with a value of 30,000 Rand, okay, which we are expected to use for 3 years, right? So if you take 30,000 and you divide it by 3, it will give you an amount of 10,000 Rand. That means each year you're going to depreciate that asset by 10,000 Rand, okay? So, in the first year, if you wrote of 10,000, and in the second year you wrote of the second 10,000, clearly you can see that your accumulated depreciation at the end of year 2 is now 20,000 Rand. Why? 10,000 in year 1, 10,000 in year 2. So your accumulated depreciation is the cumulative depreciation, the collective depreciation, right? It's that part of the asset that you have used up to and including the point at which you are working. Therefore, we come now to a term called the carrying value or the book value. So your original cost price less the depreciation that has accumulated over the period in which the asset has been in the business. In other words, look at this here. It is your cost price minus your accumulated depreciation, which will give you your carrying value or your book value. Can you see that? So the term carrying value means what is the real value of that asset? It's the cost price minus the accumulated depreciation to give you the carrying value or the book value. The terms are used interchangeably. The residual amount, the full amount of the asset cannot be written off as long as it is in the business's possession. The carrying value is kept at 1 Rand. Right, a very important aspect, and we will deal with it in detail later on in our lesson, where we say we don't write off the asset to 0. And the reason we don't do that is if you say an asset has a value of 0 rands, it actually means that it has no value. Then by definition, it does not comply with our IFRS, definition that says an asset must have a value attached to it. So yes, although it has reached the end of its useful life, it will never be ever, the cost minus the accumulated depreciation will never be 0. We'll always have a residual value of 1 Rand. So now, what we're saying is that the total cost less the residual value will be the depreciable amount. Okay, now, when you're calculating depreciation, the two methods that you use to calculate depreciation, one will be what we call the cost price method. Here, you work with the cost price. You'll notice that it is fixed. You'll also know another name for it is the fixed installment method. Another name for it is the straight line method. What is important for you to know at this stage here? That in all of this here, you work with the cost price in order to determine your depreciation. Got that? So if any of these methods are mentioned, you work with the cost price. If you're working with the asset in terms of its useful life, what you do is you say at a fixed rate over 5 years at 20% per annum. Obviously, 20%, if you multiply it by 5, will give you 100%. At the end of 5 years, the asset would now reach its residual value. The other method of depreciation is where we use the diminishing balance method. Now this one here, notice the important part is the carrying value. That means you calculate your depreciation on the carrying value. So it's called the diminishing balance method, the reducing balance method, the carrying value, the book value, or even the declining method. Basically what it means is that every year your depreciation will diminish. So what you have seen here is that when you're writing it off, notice that your depreciation will work out as a certain percentage every year, The writing of depreciation takes a longer period, and this method is regarded by SARS as the norm. Which method? The diminishing balance method. Okay, finally, if we look at our asset register, an asset register should contain the following: the description of the asset, the serial number, the date of purchase, supplier's details, and obviously the purchase price. So all the information regarding that particular asset is kept in your asset register. The asset register should contain the following information: the depreciation, your method, the amount of depreciation, your accumulated, obviously the value, and the expected residual value. So all the information regarding that particular asset is kept in your fixed asset register. Now remember something else. Your fixed assets account is the cumulative total of all your assets, but the register will be kept for each individual asset. Okay guys, that's it for this segment. Let's take a quick breather, and when you come back, we'll carry on with discussion on fixed assets. See you just now.